those people who have retired and who want to build a direct equity portfolio, I strongly suggest you should look at the last 3 to 4 videos. Now, when you want to do direct investing, don't invest in only one particular share. Have certain rules like, how much I'm going to invest in large cap, how much I'm going to invest in mid cap, how much I'm going to invest in small cap. For large cap, what will be the percentage, whether it is 50% or 60%. For mid cap, whether it is going to be 20% or 30%, and the remaining will go to small caps. And each and every cap, whether it is large, mid and small, you should know how many stocks I will be holding. In the last 3 videos, we talked about examples like HDFC Bank, we looked at Maruti Suzuki, we looked at TCS, we looked at Hindustan Unilever, we looked at HPCL, and most importantly, we started with Reliance Industries. And Reliance Industries over last 5 years gave only 22%. TCS over 5 years gave only 3% return. Over 5 years I'm talking about. And Hindustan Unilever over the past 5 years had given only 18% returns. So this and all we are doing as of October 2025. So that is the reference date that we are doing. So now the question is if you are going to build your own direct portfolio, don't go by stock tips. Do a complete research. Go for large cap, mid cap and small cap. Create a portfolio of 30 to 40 stocks. If you don't have this kind of a capability, our strong suggestion is either you have to go for index funds. So in an index fund, what will happen? You will buy all this kind of good stocks as well as bad stocks. Like, for example, when I say a good stock, I'm talking about Maruti and HPCL delivering huge amount of returns. Let's say part of Nifty 50 or Nifty 100. These are giving much better returns. At the same time, you will also invest in stocks which are not given underperforming stocks like TCS or Hindustan Unilever or Reliance, which is also part of Nifty 50. So either go for index investing, or the better option is you go for active investing in mutual funds. When you go for active investing in mutual funds, as we discussed in the previous videos, look at absolute returns, look at rolling returns, look at standard deviation, which is the measure of risk, then look at Sharpe ratio, look at trainer ratio, look at upside ratio, look at downside ratio, look at the portfolio, and more importantly, look at the short-term performance, not the long-term performance. People always give importance to, let's say, 3-year performance, 5-year performance, how the AUM has been growing and all. 5 years back, they collected the money, they performed, and all the mutual funds which started 5 years back are doing much better because they started with a lower base of COVID impact and COVID base. They are all doing much better. So what is important now is the short-term performance. When I say short-term performance, I am talking about how the performance had been for last 7 days, last 1 month, last 3 months, last 6 months and last 1 year. I think this should be a significant analysis. I would say 60% or even 50 to 60% of your focus should be on last 1 year. Whether the fund manager is performing in this particular cycle as compared to a 3-year cycle or a 5-year cycle. So this particular video will give you a lot of insights on direct equity investing. Our strong recommendation is to see the entire set of videos.